All right, so this is going to be an analysis of the energy sector. We're currently in ENBRIDGE, which is basically what the program is calling for. But there are some other companies that I think are performing a bit better, specifically Williams Brothers. So I want to go through these just real quick and just see kind of what they have to offer to see if maybe we move on from Enbridge. So number one, dividend is a big deal. Enbridge has the largest dividend out of this group. However, it's not necessarily the largest because you do have to pay foreign tax on this dividend. So I'll say that Enbridge as well as MPLX are about there, right? Williams Brothers is way down on the list, but have a lot of cash on hand. Looking at the PE ratio, it looks like MPLX has the lowest, which usually means that either is not performing very well or for whatever reason, this company is just undervalued. I think they're all pretty much in the same industry as far as what they do. All of these guys all of these guys, with the exception of Enbridge, are dealing with oil, but also the transportation of it. Enbridge is strictly natural gas. And so MPLX and Enbridge have similar PEs. Which is interesting. It makes me kind of want to go look at what MPLX does. But in my memory, I think they deal with oil and not natural gas. But either way, this one kind of stands out to me as the cheapest company, specifically when you talk about where their dividend is. Like I said, it may be because the company is not performing as well. Let's take a quick look at the current price and purchase price. Purchase price 34, current price 48. So no, I mean, it's performing well. So again, huge dividend, low PE. That's definitely something I'll be curious to take a look at. Let's move on to net profit. Net profit for KMI and Williams Brothers is really leading this group. Everyone else, I think, is about the same. And again, they're all pretty much in the same industry. So I think they really said something. Williams Brothers and KMI really doing great things there. All right, MPLX, because the return on assets is so much larger than the rest of these guys, I have to imagine that MPLX is in a different industry, right? And so their return on assets looks pretty good. The rest of these guys are about the same. So not a whole lot to be said there, other than I may want to go and take a look at what MPLX is actually doing as far as business is concerned. All right, cash on hand. Like I said, Williams Brothers is the leader on that by far. And that says a lot. And we know, looking at that dividend portfolio, looking at the M-score portfolio, that these are the companies that's performing really well right now. It's really a defensive stance, because when you're buying a share of Williams Brothers, a portion of that share is going to be just straight up cash, and cash ain't going nowhere, not anytime soon anyway. So that means a lot. And then we see the cash versus debt. Again, Williams Brothers is going to lead the group on this, just because they have a bunch of cash and probably about the same amount of debt as the rest of these guys, which are all about the same. So again, that cash looks like it makes a difference. Same thing with the price right now. All these guys are a little under their 52-week highs, all about the same. I think Williams Brothers is a bit further down, but way above it's 52-week low. Same thing with KMI. And so something tells me that what's happening is these two companies are performing better, or have performed better over these other companies over the last year, because these guys are closer to their 52-week low. But again, not far off their 52-week high. So maybe that just means that the price hasn't moved around a bunch. All right, and then the alpha. These are companies that perform well when the market is performing well, and we know that it's really sort of hit and miss. I mean, we're currently following the alpha up portfolio, and so that portfolio is doing well, But we also saw alpha in some of the worst performing portfolios. So want to be kind of careful with these, but we see that ET, MPLX, and Williams Brothers are kind of right there as far as alpha, while Enbridge is the worst performing alpha, which makes some sense. Okay, looking at the up move, again, these are companies where the price tends to move up when there's a lot of volatility. When there's a lot of buying and selling, these companies tend to make more money. And a lot of times that is because these companies are owned by institutional investors that typically buy shares and not necessarily sell shares. Whereas someone with a smaller up move like MPLX is more traders are trading this thing. And so they're buying and selling a lot. And maybe they're selling more than they're buying, which again goes back to maybe why the PE is where it is. All right, down moves. Again, these are companies that when there's a lot of buying and selling, they tend to move down less, relatively less than others. And so MPLX wins the race there. But the up moves. So it's a weird situation. I definitely want to go and look and see what's going on there. The rest of these guys are about the same, at least these three down here. All right, and then beta. These are companies that are going to perform well when the market is not performing well. And we see that ET and MPLX are pretty good betas. Whereas KMI and Williams Brothers, not so much, relatively speaking, and Enbridge, I guess, is right in the middle. Okay, 1 month return. This is the last 3 years, not including this year. So we're talking about the whole of 2023, 2022, 2021. This is the average monthly return from those years. And so we see ET is the largest return, MPLX, and then Williams Brothers is kind of right there in the middle, while Enbridge and KMI are down at the bottom. And again, this kind of makes sense to me, especially with this ET and MPLX. I think these are high flyers. All right, volatility. Volatility is just how much the stock price moves around. And so we see ET, the stock price moves around quite a bit. Again, that may have something to do with there being a lot of traders in this and not necessarily institutional investors. MPLX and the rest of these guys are right in the same area. So I'll say average. There's no winner there other than ET being highly volatile. All right, and then this is the price. Again, this is based on the Alpha Up portfolio, and so you see that Enbridge has the largest score, which is why the program is calling for Enbridge. And then we see KMI right there with them, and then Williams Brothers is not far off. I mean, it's off, but it's not far off. And then we see the M score here is really high. So for me, looking at this, Enbridge does not seem like a bad way to go. But when you look at Williams Brothers, other than the dividend, and for me, that's what's going to make the big difference here, right? The dividend for Enbridge, much higher. Dividend for Williams Brothers, much lower. But maybe we get better performance outside of that dividend. To be honest with you, it's really hard to look at just these numbers and make that decision. And the same thing goes for MPLX, right? Where you see a higher dividend, really low PE, but everything else looks decent. The only thing that MPLX does not have is even the cash on hand is better than the rest of the group, other than Williams Brothers. So what I'm going to do is the alpha looks good. The up moves and down moves is a weird situation. And again, this is the past 3 years, not including this year. So that looks weird. I'm not sure what's going on with that. The beta is good, that's a very defensive thing, but historically has a really high return, and the volatility it's not crazy. So what I'm going to do is I'm going to go back and I'm going to do a little bit of research on exactly what MPLX does, read over some more recent articles and just see if there's something maybe going on with the company outside of just, I don't know, market volatility. And then I think what I will do is when it comes to Williams Brothers and ENBRIDGE, it really seems like a toss up at this point. It really does. Williams Brothers seems to be the better deal right now. It really does. But man, the drop in dividend is really saying something. What I think is now our cutoff for our dividend is 2%, right? Once the dividend goes below 2%, this company is no longer investable for us. Maybe it makes sense to go into Williams Brothers, okay? If the price increases, which I think that's going to happen, the energy sector looks pretty bullish from this point. If the price goes up high enough that it takes that dividend below 2%, that'll be our signal to sell, right? And then we can look at possibly getting into some other company. So so MPLX, going to do some research there. And then I'll make a decision here on Williams Brothers. Maybe I'll look at the options. I'll see exactly how many shares the program is calling for. Matter of fact, let's do that now just to see what we get. I'm curious. Because remember, we want our portfolio to have a lot of energy in it, right? And so the current price is 55. We'll do 55.50. And let's run this. Oh, wait. Okay. And let's run this. And let's see what it'll give us here. And so what this solver is doing is it is running through hundreds of computations to figure out the best possible scenario to give us the highest score for the alpha up portfolio. So it's going to put all of the companies and figure out what percentage of the portfolio they ought to hold to give us the highest score for the portfolio. And it looks like, I think there is, oh, I know what it is. Is it Gilead? Let's see. I think that's good enough. Run this again. The solver was having issues earlier too, and I resolved it by changing that price for Gilead, which is closer to where it is now. It's actually $92, but let's see. Looks like before it went through about 700 different scenarios. And the highest score, I think, was 0.24. Right now it's at 0.23. It's probably going to be right about there. No, still can't find a solution. Um, I don't know. I don't know what's causing this. Let's see. Everything else, I think, is it's the only thing. Maybe take this one down to 5.3. Let's just run it again. If it doesn't work this time, I'll leave it alone and come back to it. But I was just curious. Okay. Yeah, no, it's not working. For whatever reason. I don't know. And I can always like try to do this manually. So it's giving me 0.23, I think it was the best. But I'm gonna guess that it's somewhere around this 40. Like it's not giving us um a big number here, and which makes sense because Enbridge is 0.21 and Williams Brothers only 0.18. And so you think that the largest score will command the larger number of shares. So we're talking about Cisco, we're talking about MPW, talking about Fastenal. And so Rogers ought to be a small portion of the portfolio. Gilead ought to be a small portion of the portfolio. Coca-Cola small, EXC small, and the rest of these guys fairly large. Now, how I'm going to go about correcting this, I don't know right now. But um, either way, and let me see something here. Let's run this one more time and see if maybe that fixes it. Nope, still, still can't get it done. So yeah, I don't know. But again, just looking at the numbers, it appears that Williams Brothers ought to command a fairly high percentage of the portfolio. So Regions is the largest holding. MPW, I believe, is like second largest. And so there's no reason that we can't get Williams Brothers to maybe third or fourth largest. Let's see here. So Rogers has 20%. No, sorry, 8%. You're looking up here. Okay, 8%. Regions 18, MPW 12. So yeah, so Williams close to the can get close to 12%, I imagine. Four. So yeah, 10%. So 15%, we'll put it at 300 shares. So yeah, so we can easily go out and grab 100 shares, and then we'll have at least another 100 that we can buy if the price continues to drop. And then I'll imagine that 300 will be our absolute limit for this position. None of our holdings can ever be more than 25%. And so that puts us right at 500 shares. So yeah, I think that's good. That's what we'll do. And like I said, if the price goes up high enough that the dividend falls below 2, that'll just be our selling point. And then we'll kind of reassess the portfolio and go from there.